Hello and welcome everyone to the Annuity Straight Talk podcast, episode number 134. My name is Brian Anderson, your host and founder of Talk.Com, doing this for 15 some years. Talked about interest rates last week and by popular request got a lot of people that waited a long time for this. Man with many demands on his time. Welcome John Balmer to today's episode.
Ryan, thanks for having me again. It's always good to be back on the Annuity Straight Talk podcast.
Yeah, and we've got a lot of stuff happening in the market right now. So I thought, coming off the interest rates episode last week, I want let everybody know John's here for educational, informational purposes only. Please do not search him out and find him. If you need to talk to him, you can talk to me first. You can do that by making an appointment at the top right corner of any page on AnnuityStraightTalk.com. Please like, subscribe, or comment on any of your favorite podcast platforms or on YouTube. And if you want to hit the thumbs up button, you can always send me an email. This goes out on Saturday mornings to everybody on my list. So, John, what do you see going on out there? And start with, what do you think about interest rates? I kind of did it solo last week. You don't have to agree with me. Sometimes a different perspective is good, but let's start there.
Yeah, great episode last week. Very informative for your listeners and your viewers on your YouTube channel. Yeah, lots of stuff going on in the market. We can kind of get to some charts. I can kind of give you a landscape of, the macro picture, what's going on, where I think rates might go, where the market might go, all that fun stuff. We talk a lot about risk management here. Brian, you obviously are the master in risk management with the products and services that you offer, and I'm more on the risk side. So there's obviously, we can take a look at anyone's portfolios and make some recommendations on how to protect your money, how to grow your money over the long term. You let me know where you want to go from here. We've had probably, I'd say the last 10 days have been pretty volatile in the market with rates going back up again. We thought that, going into the year, we thought we might have, I think Wall Street really expected about 5 or 6 cuts. And it's looking, a lot of people I talk to are thinking maybe 1, maybe 2. Some of the bigger shops on the street are like Vanguard, full disclosure, had them in the office about a week and a half ago, and they're thinking we might not get any rate cut whatsoever.
Well, that's something that's changed. So that's one interesting thing that I thought about interest rates, because they've been talking about, the market's been kind of moving on the possibility of an interest rate cut. And each time the Fed meets, Jerome Powell's kind of saying, well, not yet. And the most recent thing I heard him say, I guess maybe it was maybe not this year, and then at least 2 more meetings before they do anything. But what are your thoughts on that, where it's kind of been like market-driven speculation based on where interest rates might go?
Yeah, absolutely. I mean, you really saw the market come in, I'd say, off the October lows of 2023. We really came in hot during the year. We had that continued AI story. The dollar was down, rates were down, and, Wall Street and the speculators, retail traders, institutional traders, fund managers were positioning for, lower inflation and several rate cuts, which is what's coming to fruition is, inflation's still running fairly hot, despite, having strong employment. Rates are starting to head back up. Mortgages are getting a little hot. The AI story is not necessarily going to fade. That's going to be a very long-term story. I'd say over the next decade that will unfold. I think that will drive the markets higher ultimately as people adopt AI, which means artificial intelligence and the computing power behind that. But I think, we're just in a more of a corrective phase right now as we, head into, mid second quarter here of 2024. So, markets don't go up in a straight line. Returns aren't linear. I think, it's a good resting spot. We have traded back down to a couple of the strong, key indicating moving averages. Some people may be taking some profits, people readjusting their portfolios from, a good first quarter and a good fourth quarter last year.
Yeah, and I think it kind of reinforces, my thought, or kind of the general idea that market levels are more based on speculation than value. Value is a measure of the past or what's there. You get earnings come out and all that stuff comes through, it's like, okay, that justifies the value. But going forward, it's always speculation. And that's a lot of what's been built on this year. So I'm not the professional on that, but I just try to, again, I work on everybody concerned about timing. Timing is important no matter whether you're protecting assets or if you're trying to grow assets, if you're risky or if you're safe. So, it's a big key here. And that's what I guess my overall point last week was to say, I kind of think they're going to stay, rates are going to stay in this area right now. So what do you think if that happens? And you can disagree if you think something else is going to happen, but if you think that's going to happen, what would that mean for the markets? And then, or either side of that, up or down?
Yeah, I think, when rates rise or fall rapidly, you're going to get some extraneous moves in the market. There's going to be a lot more volatility. But, I mean, we can't say that, you know, take a look at the greatest bull market in history, and that could be arguable within the last 10 years or the mid 90s to the 2000 .com bubble. I mean, that was a really strong market. We had rates right along this area, even if not higher. So the economy can function on higher rates, and if anything, it was a detriment to have this zero interest rate policy. I think that people really got drunk off of having really low interest rates. It's not necessarily good for the economy. It allows inflation to run hot. And I just think that, we're the markets, valuations, earnings are going to have to grow into and have to learn to adapt to a higher rate environment. If they want inflation to come down to 2 or 2.5%, I believe, PCE and some of the key inflation indicators, they're still running a little bit hot. And we never got that the recession that we were really expecting last year. The economy's still fairly strong. So, I think things are going to stay hot and they're going to have to keep rates higher for longer.
Yeah. And what's important, I think, is like a note that I like to make is everybody thinks in terms of growing their money. But if you have an extended period where the market's essentially flat, then, time and growth, you know, come together to make, a growing portfolio. And if you have a flat market for 2 years, that's the same effect as a correction and then a rebound. So if we've covered that entire time period and we're only up 5% or so in the market, well, we're off our long-term averages there. So not necessarily, unless you have the magnificent seven, you're not getting the growth you wanted in the market.
Yeah, absolutely. And you're having to deal with a lot of ups and downs in the markets. I do think, you know, the S&P 500 was up what north of 10% in the first 3 months of the year. It comes off a really strong fourth quarter of 2023. You're looking at, the long-term average of the S&P over the last 80, 90 years is, just north of 8.5, 9%. Some could say would be higher. You were looking at 10% rate of return in one quarter. I think you had a 20% rate of return, last quarter or the last 4 months of 2023. Those are just, they're not normal returns. So I think a reversion to the mean is normal. This is a corrective phase. Do I think we're going into a bear market? No, absolutely not. The economy's still strong. I just, like I said, markets ebb and flow. There's a guy that I like and respect a lot, and he starts his morning calls off every day with stocks go up, stocks go down, then we see. So that's, you stick with long term averages, stick with market rates of return, stick with, a diversified, broad index based portfolio. Don't take huge bets in individual stocks. You will do fine as long as you are not, overextending yourself with any type of leverage.
Yeah, big
And
bets in individual stocks, you're going to lose more often than you win, right?
absolutely.
Probably,
Yeah,
unless you get
because
really lucky and
well, what happens is that people get drunk off returns in individual stocks. So you'll have someone build a very large position, and Nvidia is one, AMD, Tesla, for example. I mean, Tesla's off like 40% year to date. You have Apple, it's down 19% year to date. I mean, those are stocks where many people and lots of the indexes have very large concentrated positions because for the last decade, those are the stocks that have worked. Not necessarily saying that going forward they're not going to work again. You do have periods of time where stocks will trade off. kind of have to grow back into their valuations, retool maybe their business model, get back to growth. But having a very large concentrated position in any one particular stock is, unless you can really roll through that volatility, you're going to have a lot of sleepless nights. So, as you know, Brian, we advocate for, diversification is, the deciding factor. If you don't like the ups and downs of the market, you ought to consider an alternative and talk to, guys like you that do more conservative guaranteed type of stuff.
Yeah, well, I'll give my little annuity pitch. Why don't you show us some of your charts that you have prepared? Do you think indicators you have? But that's, again, John and I see things eye to eye. I believe in the value of growth in a portfolio. You guys know that. I don't think you should be all out of the market. I do believe you should protect a certain number of assets to maintain a lifestyle in retirement. There's a lot of people that will go one side or the other of that. Some people will accept more risk and don't mind the ups and downs in the market. A lot of people want to sleep at night and want to have a fair bit of their money protected. The older you get, the more important it is to protect money because you don't have enough time to recover, even if you do see outsized returns. And we have seen sluggish decades, 2000 to 2010, 60s and 70s had a lot of stagnation in there. So I don't know what's going to happen in the future. You just kind of hedge yourself on either side of it, right, John? Protect something, but always leave yourself in position to capture some of that good stuff.
Yeah, absolutely. Absolutely. I'll share a couple charts with you. I can share the S&P 500. I'll share the Nasdaq 100. Then I can kind of touch on rates and touch on the dollar, how they're inversely related to the markets. But let me go ahead and share my screen with you, Brian.
I'm going to ask a really simple question because it's
Yeah.
interesting. I've watched this for like seems like the last year. The Hank Jr. song, interest rates up and the stock market down. You only get mugged if you go downtown.
Yeah.
And that's like interest rates up and the stock market down is a double whammy on a portfolio. You're losing on the bonds, you're losing on the stocks. It's not
That's
supposed to work that way, right?
no for
But it seems like what we've seen is the market rises and the rates rise. So your stocks are winning and your bonds are losing. And it should be inverse to that, right? I mean, historically, that's the point of a stock bond portfolio.
Yeah. Historically, we had a 30-year bull market in bonds. Interest rates went from what, 20% down to, near zero. So your bond portfolio was consistently going up. It was always the flight to safety. And now that you've had a 400 or 500 basis point or 4 or 5% increase in bonds or the 10-year in the last, 18 months, a very rapid rise. I mean, bonds over the last 5 years are actually down. I think the Barclays Aggregate Bond Index is down 3.5% year to date. It was down last year. It was down the year before. I mean, there has not been a period of time where, bonds, which are typically what you would consider a safety trade, are actually down. The best performing fixed income asset class, and there are many income asset classes. The best performing fixed income class has been short-term treasuries and cash, yielding 4.5 to 5.1% on the short end of the curve. So, long bonds have their place in a portfolio, but there are times where you're getting stock-like returns in the bond market, which is a little unsettling to a lot of investors because we've been kind of trained over decades and decades that bonds are supposed to be safe. Well, they are unless you're in a rapidly rising interest rate environment. So,
Well, that's why if you look at models over the last 40 years, even do a Monte Carlo scenario of a blended portfolio for retirement, essentially rates have been falling since 1989 and have only recently risen in the past 3 years. There was a little
yeah,
bump in 2018, but think about what that enhanced value to the bond portfolio in a consistently lowering environment over 30 years does to projections. And so you can't necessarily say we're going to predict that. In fact, I'd say what's more normal is what we've seen in the past few years, where we've seen them coming up and down. This time last year, I want to say the 10-year treasury was down around 325 maybe.
yeah,
Went above 5, closed above 5 in November, December, fell off again, and now it's rising back up. So that's more of what I think you deal with, and that's the variability. That good risk management in the market will help you deal with that. and then being adequately protected in, non-interest rate sensitive assets in retirement. There you go. Another pitch. Dang it. Here I am selling things.
Yeah, absolutely. Let's take a look. And let's take a look at this is the daily candle chart of the S&P 500. I represent it with the SPY. A lot of clients, it's the largest ETF, exchange traded fund out there. This is a daily candle chart going back to about right around December. And you can kind of see here, I'm actually going to go year to date here. So this green candle right here is January 2nd, 2024. This red line represents the 100-day simple moving average. The yellow line represents the 50-day simple moving average. And this purple line, which is a line that I draw almost every year, is what's called the anchored volume weighted average price. And I drew that at the beginning of the year. I always draw it. And look to where we've come down to. That's not by coincidence, it's a level of interest. But it's interesting that we do have that volume weighted average price right here, that purple line. So we slice through the 50-day. I always say the 20-day acts like a rubber band, but the 50-day, it hasn't been really relevant in the last year. But we came down to it. We tested it, last Friday? On Monday, we sliced right through it, which kind of meant we were probably going to slice all the way down to the volume weighted average price, anchored to the beginning of the year. Kind of holding that steady. I thought we were going to get a nice bounce today. We tried to get a bounce. So you're going to probably see the market trade down. My bet would be if rates continue to rise, and I think rates were down today. We can get to that chart, but we'll probably, now we're in this range. So we'll probably have a bounce tomorrow. Maybe we'll have a bounce on Monday. And we may bounce back up to this 50-day moving average, this yellow line here. And it'll probably be range bound. That's what I tell people to expect. The market will probably be pretty range bound. I'm going to remove that drawing. Be range bound in this area. We may get down to the 100-day moving average. I'd hate to see these start to curl down. That wouldn't be very good. The 200 SMA, or the 200 simple moving average, if we take a look at, that's way down, and I can put that on the chart, Brian. That's kind of an extreme case. I don't know if we'll get back down there, but that's an extreme case. That's this orange line down here. That's at 471 on the SPY. That's a pretty big move. I would say that's a move. That's another 5.5% on the downside. That would give up basically all of the gains for the first quarter of the year. Could get pretty ugly. I don't think we'll get down there, but it's something to consider. Not to say that we're going back into a bear market.
Not trying to scare anybody, right? Just
No, not trying to scare. I mean, then this is normal. That's why I always tell people, be cautious of where you are. Think long term in your portfolio. You have had probably pretty good gains over the last, year and a half since the 2020 bottom. Nominal returns. If you were in the top 20 stocks individually, you've done phenomenally well. If you have a diversified portfolio, you're probably anywhere between, up 5 and up 12%. But these are areas of interest that we want to take into consideration. So holding the volume weighted average price from the beginning of the year probably will make it down to the 100-day and probably get a pretty significant bounce off that. Uh, I want to throw in, kind of a wild card there. We are in an election year, in a pretty what will probably be a pretty exciting election on one side or the other. I don't know. Who knows?
That's the podcast my marketing guys say. Do the election. I'm waiting. I got it. I'm just waiting. It's not time.
Yeah.
He says everybody else is doing it. I'm like, I'm not like everybody else. I'm going to do it when they're not. And I'm going to have a better idea what I'm talking about, because they're all just blowing smoke right now. They don't know nothing.
Yeah, that's right. The time to do that podcast is, the night of the election, and we'll see what the markets do on the day after. Again, stocks go up, stocks go down, then we see. But we can definitely kind of know where we're going to be going. I would say, we're going to have some downward momentum. We're in a corrective phase. We're still in a primary uptrend in the market. And, that's something that I always tell people. I'm going to kind of switch screens here. This is you can see this blue line here and this red line. That's a channel going back to the 2009 bottom. And you can see that we are in this channel almost right in the middle. So, you can see here's our COVID low. We sliced through the channel, came right back up to the top of the channel, and the bottom of 2022 hit the bottom of the channel. The bottom of 23 hit the bottom of the channel, and we're kind of middle. So, we could go up, we could go down, but if we extended this out, we are still in a primary uptrend. We're still in a primary bull market. I think our big bear market for, the next several years was that blow off top in 2022. NASDAQ lost 40%, S&P max drawdown was 26, and we've kind of started to work our way back out of that. But, this is a pretty wide channel that we could get through. So just keep that in mind. The
Yeah.
market goes up and to the right, but, it has fits and starts. I'm going to take you to the NASDAQ 100, which is the QQQ. That's more tech oriented, tech focused. Again, we have the 200 simple moving average way down here at 399. We're at 423 right now. We did slice right through this 50-day simple moving average. You can see that we kind of bounced and we kind of did the dance for several days when we came down to that average. It acted as support. And we saw this big down day, bounced off of it, bounced off of it, bounced off of it. I mean, it's like almost like a ping pong game. Finally sliced through to it. And where did it slice through? To the year to date volume weighted average price. Held there for 2 days, sliced through it on Monday, right back down to the 100-day. So this is the NASDAQ QQQ. And a lot of that has to do with the weighting. You got to remember, these are market cap weighted indexes. So what are some of the biggest stocks? Nvidia is sort of starting to trade down. That's a very big stock. Microsoft is starting to trade down. Apple is down 19% year to date. Tesla is down 40% year to date. Tesla is probably on its way to 125 bucks, maybe lower. We'll see. We'll see what Elon does. But not a bear market, but just a corrective phase. So you can kind of see markets rolled over, hitting some key points on the charts. We can kind of look at where the dollar is. So this is the US dollar, not consequently, the dollar's been going up since the beginning of the year. It's really started to accelerate here, and we're kind of back up to the level where we were. If the dollar should fall here, this is the dollar index, so the dollar's getting stronger. If the dollar should fall like it did back here between October and January, we'll see the markets rally significantly, and that's where we saw. But the dollar's been actually rallying along with the market. So most of the time it's inversely correlated. Sometimes, they do often trade in parallel. And then we can kind of take a look at the 10-year note. You can see, rates have been steadily increasingly rising since the beginning of the year. And, you had that October to January rally. You saw how rates fell pretty precipitously. So, I would say, do we get back up to this 5% level? Going out a little bit further, yeah, I don't know. We'll see. Is that a bad thing? It's not a bad thing to get 5.5% on your cash, but cash is not a great long-term asset class. But it also will push up mortgages and a lot of things like that. Oil's also been rising, so we can kind of take a look at oil. Oil's back up to it's $81. Kind of fallen off, but it's had a pretty strong rally since the middle of December, where it was down right around the 67 mark, rallied up to about 87. Probably going to trade in this range for probably the next couple of years. So those are a lot of factors involved. We could talk about Bitcoin if you want. That's probably not
Nah, forget Bitcoin.
It's not in the, the wheelhouse of a lot of people that I work with. I'm sure certainly not the people that you work with. You just have to keep things in perspective. Markets don't always go up in a straight line. You're going to have opportunities to buy in lower. That's why, a lot of clients that I work with, they ask me all the time, why do I have so much cash in my portfolio? Well, if I can earn 5% yield on that cash while we sit and wait for the market to correct itself or present a better buying opportunity, we're going to do that. And it's still accretive to the portfolio. Just because it's, in a money market account doesn't mean it's not adding, alpha or upside return to the portfolio, or buffering or adding, a hedge to the portfolio when the markets are selling off. So
Yeah, that's it. Well, I've talked to a lot of people who've been scared of the market and don't want to make long-term commitments. With me, it's like a lot of people are confused, getting pitched on different things, and they just freeze. And I said, that's a good place to sit. And in the last couple of years, it's been good. Now, when you get ready to make a long-term decision, it's better to commit because those things aren't locked in. They're going to fluctuate on a daily basis, but not a bad spot for the short term. A lot of people can do pretty well and buy themselves some time, because I think we do have time. Like you said, if the market trades in this range, even if we do go down to the 200 day, you're still, you're not taking major losses. I talked to a lady a couple of days ago, and for the record, this is April 18th, Thursday, April 18th. So I think it's fair to put a timestamp on this for anybody that's going to listen to it. It's going to go out tonight, and then obviously to the email list on Saturday. So it's relatively timely to all this volatility we're seeing in the last few days. But I talked to a lady today, or a couple of days ago, that said, I don't have as much money as I had 2 weeks ago. And I said, well, you never had it to begin with, so what's the big deal? And, kind of a person, an older lady who would probably be fine, but somebody's got her all in the market and she's nervous about it. So anyway, but cash isn't a bad holding spot. It's not a long-term plan, but it's done fairly well for people in a couple of years.
yeah, absolutely. I mean, can be a very strategic asset class outside of, using more derivative type of securities to hedge your portfolio. Cash is particularly, and people haven't had this type of a rate of return on their cash, particularly my higher net worth clients that are sitting on, several $100,000 worth of cash. They've never gotten this type of yield in the last 20 years.
Yeah, it ain't bad.
They don't have a problem with it at all. The market will present opportunities to buy in. I do think, we end the year, probably where we started, plus 10%. God forbid we have something go off. We've had a lot of crazy things go on. If you look from a geopolitical standpoint, we have an ongoing war in Europe. We have a new war going on in the Middle East. We've had some activity over the last weekend. You know, oil has been spiking. You have unrest in the United States. You have a crazy election that's going to be coming up that could really become very volatile with the markets. And yet here we are, 3% off all-time record highs. So, you have got to think about it long term. You've got to have your portfolio that's going to generate income and growth. And, don't get me wrong, if you're a safety person, by all means, go into safety. I always tell people, you should be positioned that you can sleep at night. And if you can't sleep at night, then you're in the wrong type of portfolio.
That's good advice, actually. No matter what type of assets you hold, whatever your preference is, you should be able to sleep. So, hey, John, thanks so much for giving your opinion and your perspective on this. I know a lot of people really like it. Sorry it's been so long, but grateful for you to showing up today with all you got going on. And yeah, I can't wait to have you back again.
Appreciate it, Brian. Thanks for having me, and I look forward to seeing you soon.
All right, you will do that. And everybody, thanks again for joining us. This has been episode 134, talking about market analysis with John Balmer. Go ahead and like, subscribe, or comment on any of your favorite podcast platforms or on YouTube. You want to schedule a call with me, you can do it on the top right corner of any page on AnnuityStraightTalk.com. Look forward to speaking with you guys. Have a great day, and I will see you back here for episode 135 next week.
You have been listening to Annuity Straight Talk. The preceding information is for informational and educational purposes only and does not represent tax, legal, or investment advice. The views expressed by guests on this program are their own and do not necessarily reflect the views of Annuity Straight Talk or its partners. No information presented today should be acted upon without meeting with a qualified and licensed professional. It is important that you read all insurance contract disclosures carefully before making a purchase decision. Guarantees are based on the financial strength and claims paying ability of the insurance company.